Hi everybody, and welcome back to video number 2 in chapter 14. And when we left off, we would just finished dividends, and one point on dividends is that there is no requirement by corporations to pay a dividend, but normally the big, more mature corporations do. All right. In issuing common stock, then they follow these procedures. The state of incorporation must authorize the stock. That's where you see the authorized shares. And then the corporation then offers to sell offers shares for sale, entering into contracts to sell that stock. And then after receiving the amounts for the stock, the corporation issues shares and prepares the appropriate journal entries, some of which you've already had in your previous 1A or 101 courses. The par value has no relationship to its fair value, as you probably know. A company uses two accounts to record the issuance of that common stock. Common stock, that's the account that reflects the par value, if there is a par value, of the issued shares. A company credits this account when it originally issues the shares. Paid in capital in excess of par is the difference between the common stock issued at par and the paid in capital of the amount of cash received. It does not have greater claims on the excess paid than other holders of the same class of shares. All right, let's take a look at an illustration. Here, Trip Nerd issues 4,000 shares of stock with a par value of $1 for $10. So what does that journal entry look like? We'll take the 4,000 shares times the $10, and that gives us $40,000 of cash that we've received, and we split it between the 4,000 shares at par value here, and the differential between 40,000 and 4,000, which is 36,000, representing $9 per share for paid in capital in excess of par. Now, if there's no par stock, then the journal entry is even easier. We just debit cash for $40,000 and credit common stock, no par value for $40,000. Now, if they issue another 500 shares for $11 per share, it's just simply going to make that journal entry 500 times $11 per share as the debit of the cash that we received, and a credit to common stock, no par value, for $5,500. Okay, if it's a no par stock, but it has a stated value, it's very similar to what we would do with a no par stock. So same facts as the previous slide. What would they make to record this journal entry? All right, again, we're going to receive cash of $40,000, but the stated value was $1, just like it was for the par value. So common stock will be credited for $44,000, and the difference between $4,000 and $40,000, $36,000, will be the credit. Pretty straightforward there. And I think you've had that previously, so we shall move on. Corporate capital. Now, here is a little tricky. The stock is issued with other securities in a lump sum basis. So how do we allocate the proceeds? We have two methods, the proportional method and the incremental method. So here is an illustration. Twyla issues 1,000 shares here at $1 stated value, having a fair value of $20 per share, and the 1,000 shares of $1 par value preferred stock having a fair value of $12 per share, for a total of $30,000. How would Twyla allocate the proceeds between the two classes of stock under the proportional method, and what would they do to record this transaction. So under the proportional method, we're going to allocate this $30,000 as follows. The fair value of the common stock, that would be the $1,000 times $20, or $20,000. Fair value of preferred stock, 1,000 shares times $12 per share. Okay. And so the aggregate fair value is $32,000. So we're going to take 20,000 as a percentage of 32,000. Here's the 20,000, here's the 32,000, and multiply it times the 30,000 to get 18,750. We do the same thing with preferred stock to get 11,250. So the total allocated was $30,000. We debit cash for 30,000, common stock, $1 times 1,000 shares, and then we take the differential between 18,750 and $1,000, or 17,750, as paid in capital in excess of par common stock. Then for preferred stock, we do the same thing. We take the $1,000 par value here, given in the problem, and then the difference between 11,250 and $1,000 is 10,250, and that's going to be our paid in capital in excess of par preferred stock. So pretty straightforward there for allocating those based on the proportional method. Now, if we take a look at the incremental method, same situation as before. So here's our lump sum receipt, and in this case, the preferred shares don't have any established fair value. So what we do is we take what we're going to allocate to the common, which is 20,000, and then subtract it from 30,000 to get the difference being allocated to preferred. So again, we receive 30,000 in cash, $1,000 of par value, common stock, additional paid in capital of the difference between 20,000 and 1,000, 19,000 here, and then preferred stock is that differential, $1,000 of par and 9,000 of paid in capital in excess of par. Okay, slight difference between proportional and incremental methods, but I think you get it. All right, sometimes, rarely, admittedly, we issue stock in non-cash transactions. So as a general rule, the company should record stock for services or property other than cash at the fair value of the stock issued, or the fair value of the non-cash consideration received, whichever is more clearly determinable. Okay, so let's take a look. Marlowe cannot readily determine the fair value of the patent, but it knows the fair value of the stock is $140,000. So we're going to debit patents for $140,000 and credit common stock, that would be par value times, which is $10, times 10,000 shares. Didn't get that in the numbers up here, but that's what it would be. And then that difference is going to be paid in capital in excess of par common stock for $40,000. Now, if Marlowe cannot readily determine the fair value of the stock, but it determines the fair value of the patent is $150,000, then we change the numbers slightly to value patents at $150,000, common stock at $100,000, as we did here, and the difference being paid in capital in excess of par common stock for $50,000. Now, if they cannot readily determine the fair value of the stock nor the fair value of the patent, then you got to go get an independent consultant, and they're going to value this patent at $125,000. based on discounted expected cash flows. We will get into more about discounted cash flows in depth in this course. Okay, so we're going to debit patents for the $125,000. Again, common stock is going to be $100,000, and the difference paid in capital in excess of par common stock for $25,000. Okay, what are included in the costs of issuing stock? The direct costs incurred to sell the stock, and that includes the underwriting costs, the accounting and legal fees, printing costs, and of course taxes. And that should be reported as reduction of the amounts paid in capital in excess of par. Okay, let's look at that a little bit. Here, II-Chapt recently issued 1 million shares, dollar par value common stock at a total price of $8 million. Costs incurred in issuing the stock are underwriter fees, $500,000, printing fees, $29,000, external legal fees, $250,000, and travel costs of $25,000 related to road shows in order to sell those shares to potential investors, and then $50,000 of indirect costs from II-Chapt's internal legal and accounting teams working on that stock issue. So the question is, what entry would II-Chapt make to record this transaction? So if I sum the underwriting fees, printing fees, external fees, and travel costs, that totals $804,000, and that should reduce the additional paid in capital related to the issuance of the common stock. So the entry then, we're going to still receive the $8 million given the problem. Common stock is still going to be $10 times 1 million shares, and then paid in capital in excess of par is the $7 million differential. The amount charged to paid in capital, you'll notice we're debiting paid in capital here for $804,000, where we credited it here. We'll debit paid in capital for that $804,000 and credit cash to pay for it. So what that is the internal legal and accounting costs for working on the issuance should be expensed, because these costs would have incurred even if II-Chapt had not issued the common stock. Important concept there. Okay. All right, preferred stock. Here, preferred stockholders receive dividends before common stockholders. That's where the preference exists. In many cases, if a dividend is not paid each year, it is required to be paid in the future before common stock receives any dividends. That's referred to as cumulative preferred stock. Now, generally speaking, preferred stockholders don't have any voting rights. But if the company liquidates, basically meaning they go bankrupt, preferred stockholders have a claim on the company's assets after the creditor's claims are paid, and therefore before common stockholders are paid. The term, because preferred stock is generally perpetual or redeemable by the owner because of a specific event. In limited cases, the preferred stock is mandatorily redeemable and reported as a liability. Okay, so if we look at this real quickly here, the bank issues of 10,000 shares of $10 par value for $12 per share. Pretty straightforward. We received $120,000 in cash, and we break it into the two pieces of preferred stock and paid in capital in excess of par. Okay, that looks like a good place for us to stop this video, and when we return, we'll continue on with stockholders' equity. Until that time, Bye for now.